Good day, everyone. It's part of the panel report for the course. Decision as taught by Mr. Omar. In this study, we evaluate the economic feasibility of vessel leasing project using a value at risk approach from the perspective of the vessel owner. The objective is to assess not only the expected financial return, but also the potential downside risk arising from uncertain market conditions. Next, this is table of the contents. Next. From the background, this study focused on vessel leasing as a key business model in the shipping and oil and gas logistics sector. Through vessel leasing, energy companies such as Pertamina can secure transportation capacity without owning the vessel directly. From the lessor perspective, the business requires a large upfront capital investment, while returns are mainly generated from charter revenue over the project life. Therefore, evaluating the financial feasibility of vessel leasing project is crucial before committing to a long-term investment. Next, about financial evaluation challenge in vessel leasing project. However, vessel leasing project faces several financial challenges. First, the investment in capital intensive, making feasibility sensitive to change in capital costs. Second, operating costs such as fuel, maintenance, and crew expenses are uncertain and affected by inflation. Third, charter revenue is volatile and highly dependent on market conditions. And lastly, traditional deterministic DCF analysis relies on fixed assumptions and does not fully capture uncertainty or potential downside risk. Next. In practice, vessel leasing projects are commonly evaluated using deterministic DCF methods, which often show positive NPV and attractive ERR under best case assumption. However, shipping markets are highly volatile and adverse change in revenue. Our capital investment can significantly affect project performance. This leads to our research question. How economically feasible in the vessel leasing project when financial uncertainty is explicitly considered? And what's the potential downside risk faced by the vessel owner? To address this question, we apply a Monte Carlo-based value at risk approach. Next.
So this slide presents the main limitation of our study. So the first, the analysis focused primarily on the financial feasibility of shipping investment, while operational, environmental, and regulatory aspects are not examined in detail. So the second one, the model relies on several market assumptions, including freight or charter rates, operating costs, and vessel residual value. So the third, uncertainty is modeled using Monte Carlo simulation. So finally, the evaluation in conduct over a fixed investment horizon. Okay, next. Okay, this slide highlights the gap identified from previous studies. The first stream of research focused on freight rate risk, and another stream of study examined ship investment appraisal under uncertainty. However, despite these contributions, there is still limited research that integrates project level DCF feasibility analysis with Monte Carlo based VAR outputs. Next. So this slide explains the concept of value at risk. Next. Okay, next. This slide explains the role of Monte Carlo simulation in this study. Monte Carlo simulation is statistical technique used to model uncertainty by generating multiple randomized scenarios. Within value at risk analysis, this method evaluates value variation across scenario to estimate potential loss under adverse conditions. Okay, next. Okay, the next slide was explain the discount cash flow or DCF method used in this study. So this is a financial evaluation approach that estimates the present value of future cash flow by discounting them to reflect the time value of money. Yeah. Next.
On this slide, I will briefly explain our methodology. First, the objective. We analyze the financial feasibility of the shipping investment by combining discount cash flow analysis with Monte Carlo-based value at risk, allowing us to quantify uncertainty and downside risk. Second, the rationale. Determining DCF alone does not capture market volatility. Charter revenue and operating costs are uncertain, so value at risk help us measure potential loss at defined confidence level and support risk-aware investment decision. And finally, for the process, we define key inputs such as CAPEX, OPEX, uncertainty factor, and the DCF structure. The main output are NPV AR, ERR AR, and key financial variable. And all analysis is performed using by Python and Microsoft Excel. And next. And here for the flowchart process for our analysis, and we start by collecting and validating all input data to ensure the reliability of our assumptions. Next, we build the discount cash flow model to obtain baseline financial indicator. And after that, we identify uncertain and risk variable that may affect project performance. These uncertainties are the modeled using Monte Carlo simulation in Python to generate multiple possible scenarios. And based on the simulation result, we calculate value at risk and conduct sensitivity and correlation analysis to understand the main risk drivers. And finally, we evaluate the project financial feasibility under risk and use this result to support informed investment decision.
Okay, so on this slide, I'll explain two main components. So our main components are CapEx and OpEx. So CapEx is the upfront costs for purchasing the ships, which is 8 million Indonesian rupiah, and OpEx represents the daily operating expenses. We calculated using 350 operating days per year and adjust it with the inflations. So as a result, the annual OpEx increases slightly from year 1 to year 5, as you can see on the slide. And then next, for the risk and analysis, we use three key variables: OpEx, CapEx, and annual charter revenue. Each variable has its own probability distribution to capture the uncertainty. And then we run a Monte Carlo simulation with a 95% confidence level. At least 1,000 iterations are needed to get reliable results. And then next. And this slide shows the project's cash flow over 6 years. The main income comes from charter revenue, while the expenses include CapEx, OpEx, interest, and taxes. The results are positive. The ERR is 26%. The NPV is about around 1.7 Indonesian rupiah, 1.7 million Indonesian rupiah. Since the ERR is higher than the 12% risk-free rate, the project is considered feasible and profitable. Next.
Okay, on this slide, we look at the distribution of NPV from the Monte Carlo simulation. At a 95% confidence level, the NPV at risk is about minus 1.68 million USD, shown by the red dashes line on the left. This means that in the worst 5% of scenarios, when CapEx is high, operating costs are high, and charter revenue is low, the project could destroy up to around 1.68 million USD in value. At the same time, the upside probability is very small, only about 0.1% of simulation produce an extremely high outcome where NPV is even higher than in the initial CapEx. So the downside risk is meaningful, while very extreme upside scenarios are rare. Okay, here we see the distribution of ERR. The ERR at risk at 95% confidence is around minus 0.02%, which is essentially break even. In other words, is the worst 5% of case the project just about failed to generate a positive rate of return. More positively, about 77% of the simulation deliver an ERR above our 12% benchmark, but that still leaves a 33 chance that the project underperforms this target. Okay, this heat map shows how each risk driver is correlated with NPV and ERR. On the cost side, CapEx has only a very weak negative correlation with NPV and ERR, while the OpEx factor shows a moderate negative correlation. That tells us that higher operating costs do hurt profitability, but overall cost uncertainty is not the main driver of project value. On the revenue side, the charter factor has a very strong positive correlation with both NPV and ERR, so changes in charter rates or utilization almost directly translate into changes in project value. NPV and ARR themselves are almost perfectly correlated, meaning both metrics are telling the same story. Okay, and finally, this slide look at the VRR or the main input variables. For CapEx, the 95% VAR is about 7.76 million USD, which can interpret as a conservative minimum capital requirement in most scenarios. For OpEx, the 95% VAR is roughly 0.87 million USD per year, indicating that operating costs are relatively stable and unlikely to fall below this level. And for annual charter revenue, the 95% VIR is around 0.77 million USD. This gives us practical estimate of minimum expected revenue in weak market condition, and it also confirms our earlier finding that revenue volatility is the main source of risk for the project. Next.
So, based on the analysis, the deterministic DCF results show that the facilitating project is financially feasible. With a positive NPV and ERR above the 12% benchmark, However, the value at risk analysis show a significant downside risk where the NPV at the 95% confidence level is around minus 1.69 million US dollar and the ERR at risk is close to break even. The result also show that fluctuation in charter revenue are the main source of project risk. Therefore, the project can be accepted on conditional basis as long as management is willing to accept the identified downside risk. Risk mitigation should focus on stabilizing charter revenue, for example, through long-term charter contract. In addition, future investment decisions should combine par-based measure with traditional NPV and ERR to support more risk-aware decision making. In conclusion, this study highlights the importance to incorporating risk-based analysis in evaluating capital-intensive shipping investment. By combining traditional financial indicator with value at risk, decision maker can gain a more comprehensive understanding of both expected returns and potential downside risk. Next. That's all from our presentation. Thank you for your attention.